Hello friends, today we have very interesting topic to discuss on. Yesterday, Federal Reserve of America has increased their interest rate for the fifth time to tame inflation. Their current inflation is around 8.2% and they are targeting to reach to 2%. And through this rate, they are expecting that slowly they will reach to that target inflation rate. But here we are basically going to discuss what impact it will have on UAE and other countries. In the process, we are also going to learn how this inflation and interest rate are linked. So let's see how it goes. Inflation and interest rate are linked. In order to understand the entire linkage, you have to understand why inflation, first of all, happens. So inflation is a general price rise for a country. Is called inflation, which basically means prices are in general increasing, and there could be many reasons for that. And here we are going to discuss some of the reasons. The most important reason can be termed as demand pull inflation, where you can see that aggregate demand is greater than aggregate supply. That basically means people are demanding more goods and services than what the economy can produce. Right. So typically in that case there is a shortage kind of scenario where you can see that that prices are going up in this situation. The second type could be known as cost push inflation. So cost push inflation, as the name suggests, is because of the supply bottlenecks leading to increase in cost, and that cost is reflected in the price with the increase in price. Right, very recently you might have seen that there are shocks like oil shock because of Ukraine war, and also shocks like flood and droughts, etc. Are other solid reasons for this economy to have inflation. Okay, so how policymakers deal with high inflation? They basically deal with high inflation. Typically, they use two policies. The first policy is very prominent, which is actually applied through the central bank like Federal Reserve, which is known as monetary policy. And according to this policy, what they do is they reduce the supply of money in the economy. And one easiest way to do that is through the federal rate, or you can say the interest rate. So because this interest rate is linked with all other interest rates that is available in the country, and as a result of interest rate increase, money supply is reduced in the economy. Okay, the second one is called fiscal policy. And fiscal policy basically it talks about government expenditure policy, where government wants aggregate demand to go down. So using this fiscal policy, they reduces aggregate demand. Okay, but in actual world, you can see that the application of monetary policy and fiscal policy simultaneously. Right. Idea is to slow down the economy, contract the economy in such a way that the prices can be under control. So what happens when rates are increased? Rates are increased obviously translates into other rates like borrowing rates and deposit rates and all other rates that you can imagine in banking system, right? By increasing the rate, what government expects or what the economy expects us to do is this: we as consumer should save more because rates are now attractive for you to go and deposit your money in the bank to avail these rates and consume less. Obviously, if you are saving more, then consumption is going to be less, because income is basically divided into two. One is saving, the other one is consumption. Okay, so demand for goods and services will go down if you have more money saved, so automatically that will reduce the aggregate demand. And typically when rates are high, consumers postpone big investment to a later date because cost of borrowing is high for them. The same is applicable for the business sector as well. Business sectors also reduces their borrowing because of high rates, and that will slow down the investment, and that investment will ultimately slow down the GDP growth rate, right? So if GDP goes down, you will see that that all other economic activities will go down, right? So this is exactly what happens. And how stock market treat this kind of rate hikes. Typically stock markets may not like interest rate to be very high because they want businesses to have access to borrowing at a lower rate, and that really reflected in today's stock market, where mostly all the markets are in red. Okay, other economics impact can be very interesting to see, especially in UAE, because UAE is having a pegged exchange rate system with dollar. So whatever policy America adopts, you will see the same policy is automatically applicable in the context of the UAE, right? So rightly you can see that UAE central bank has increased the rates today. Okay, so what could be the impact for this? Impact is very simple. Cost of borrowing is going to be higher, private investment may come down, and it may have negative impact on the growth, right? So is there any positive side to this? Basically, those who are remitting money to their country from UAE or any Middle East countries like to India, Pakistan, Sri Lanka, or maybe Philippines, actually they may gain because exchange rate is now better, and that also can be seen from the news clip shown. And you will see that if you are having money which you are waiting for remitting to India or any other country, you can wait for a few days, your rates are going to be better. Okay, so now the most interesting question, will this be sufficient to tame inflation? That is a very difficult question, may not be very easy to answer as well, because it depends on so many factors. Some factors are under your control, which you have already done it, but there are many which are not under your control, right? And in that case the whole thing will depend on these factors. Like if oil prices are going down, that will give a very big help to reduce inflation. If aggregate supply is increasing faster than the aggregate demand, that is also a very big plus for reducing inflation. And last but not the least, if a Ukraine war gets over, then that will also help in improving that inflationary situation by having a lower inflation, right? So what is the conclusion of today's video? It's very simple. The answer is just wait and watch what will happen near future. But at the same time, one should be very careful that this economics or this slowdown should not end up in having a big recession, where it is very difficult for the economies to return to the normal situation. So with this, I end this video, and I expect you to learn, keep learning, and keep watching my channel. Thank you very much. Bye bye.